Happy Monday, everybody. I hope you had a great weekend. Back to the grindstone, another one of those 5-day work weeks ahead. Let's review what happened last week, preview the upcoming week's markets. Markets started last week moving higher, but not at any major conviction. Strong eco data and expectations of a 50 basis point rate cut had soft landing thoughts top of mind. Eco data from China was not as good. Retail sales and home prices disappointed, while the US data is easing the recession fears. And as Powell said a few months ago, not seeing the stag or the inflation. So by the end of the day, the Dow was up half of 1%, S&P was up less than a quarter of 1%, and the Nasdaq was down on the day, down half of 1%. Apple was the big loser on the day, took the Nasdaq down as it represents almost 10% of the Nasdaq, only 7% of the S&P, but you can see it took the toll on both indices. Worried about the iPhone sales, did not help that Warren Buffett sold some of his shares, a few $billion worth. Not to worry, he still does believe, seemingly to the tune of about $91 billion, or still almost 30% of Berkshire. So we'll see how that goes. Microsoft helped things get started on Tuesday. Markets responded, opening higher as Microsoft announced a 10% dividend increase and a $60 billion buyback. Now, before you get too excited, $60 billion is a big number, but in the world of an over $3 trillion market cap of Microsoft, it's less than 2%. Intel did get in on the action too with the deal, announcement of a deal with Amazon's AWS. Later in the week, you'll hear in a second, even into this week, more news on Intel. Overall, the buying died off and the markets drifted lower, taking a short break from the last few months. A poor 20-year Treasury auction didn't help, and some politicians are pushing the Fed with a letter pushing for bigger cuts. So much for not making this look too political. What happened to the idea of not making any Fed moves within 6 months of the election? Not happening. Eco data in the form of retail sales came in with a headline that made it seem better than it was, but it still held that we are not yet falling off the growth cliff that I keep warning about. We are on the lookout. Positioning for the Fed announcement took over, and by the end of the day, all three indices were pretty close to unchanged. The Dow was down a hair, the S&P was up a hair, the Nasdaq was up just under 1/4%. Markets opened as expected on Wednesday, quiet and waiting. Simply reported, the Fed met all expectations with a 50 basis point cut and promises of more to come. For the end of the year, the dots look like another 50 to 100, and then another 100 next year. We know how those predictions work. Remember where we were earlier this year, just this year, 6 cuts, then 0 cuts, then back to 6 cuts. We are data dependent, so we'll see what happens. Markets reacted to both the decision and the press conference with buying that gave way to sell the news, and markets closed down on the day. Recall that we spoke last week about half of the algos had to be on the wrong side of this trade. So back and forth we went. By the end of the day, the Dow was down 1/4%. S&P and the Nasdaq were also both down about 1/3 of 1%. And that did not last long. So after sleeping on it, markets opened like a rocket Thursday morning. Labor market news, the news that Powell has told us is the most important to him, jobless claims and continuing claims, declined more than expected. Again, backing up the soft landing idea. Markets did lose a little steam at the close, but still finished strong. The Dow closed up 1.25%, S&P up almost 1.75%, and the Nasdaq up 2.5%. Markets did open slightly lower on Friday after the big move on Thursday and the solid week. Japanese central bank did not raise rates overnight, and that did keep the carry trade worry quiet for now. As markets are hitting new highs, we seem to be getting everyone who needs to adjust their year-end market calls. Everything from lower to higher, crash to rally, all kinds of stats. According to Schroeder, based on rate cutting cycles since 1928, stocks, bonds, and cash have all produced positive returns on average in the 12 months after the cut started, and many other stats that say the recession is coming too. Like I said, all kind of stats back and forth. Although it was ignored outside of just that stock, FedEx, which has long been watched as a measure of economic activity, missed earnings and guided lower. But aside from taking that stock down, no one really cared. Takeover talks hit Intel, as I mentioned, so that was news also. Markets closed Friday mixed. The Dow was up slightly, but still at a record high close. S&P was down 1/4%, and the Nasdaq was down 1/3 of 1%. For the week, the Dow was up 1 2/3%, another strong week. S&P up 1 1/3%, the Nasdaq up 1.5%. Last week, we did see an end to the second longest rate pause ever, over 420 days. Longest ever, anyone? Does anyone know? 2006 to 2007, 446 days. This has been the best rate pause time frame in terms of S&P returns. Since the last rate hike in July of 2023, the S&P is up close to 25%. 06-07 time frame was up 22%. After cuts, the record's mixed. There are many who think the recession that we've been fearing for the past few years is coming, and for those, there are statistics. And for the others, when there is not a recession, the S&P rose an average of almost 10% in the following 6 months. Let's look ahead to this week, and then we'll be off into the week again. This week will be full. First of all, Fed heads have been released back to speak again, and speak they will. By the end of the week, we'll hear from Powell himself, as well as Bostic, Goolsbee, Kashkari, Collins, Williams, and Bowman. By the way, Bowman was the first dissenting vote on the FOMC since 2005. Fun fact. We will get some U.S. eco data and jobless claims on Thursday. Remember, Powell himself has said that he is watching labor the most at this time. As if inflation still matters, maybe only to the Fed head Bowman, we will also see PCE this week. Recall that this is the Fed's favorite inflation gauge to watch. But as I said, and as Powell has pretty much told us, they think inflation is not a problem anymore. It's on its way to the target of 2%. We'll also see a GDP print, and I maintain that remains important since we are still watching the growth momentum. Definitely slowing, but it's not gone. Final point here. Speaking of growth, there is a great article I read this morning talking about maybe one reason we're seeing so much consumption, spending, and credit card debt, and the likes like that. Gen Z and millennials are on a doomsday spending spree, according to the article. This is being seen all over, and it's just based on the idea that they are fighting an uphill battle. They're not seeing success coming in savings or investing. So the idea of YOLO comes in. You only live once. And they seem to spend and not save. Seeming they are reading Epicurus, the philosopher that is attributed with the eat, drink, and be merry, for tomorrow we may die. Not a good state of affairs. Look around, spending like this cannot be good. If you're wondering about some ideas on how to look at savings and investing differently than that, as most of you that I speak to are, please stay in touch and keep an eye out for some special videos as well as the normal Friday planning video coming up. For now, stay in touch and have a great week.